Money. This is episode 127, How Much in Real Estate and Other Investments for Financial Independence. This is the 39.6 Facebook and YouTube Live Finance Show, the show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for childcare, paying for college, and even the car you drive. Today we take another listener question from the Facebook group. This one's from Jyoti. Is there a method to developing one's investment strategy? For example, if I have X amount in cash, Y amount in retirement accounts, and I want to invest Z amount in real estate to get A cash flow monthly by B years, what is the way to go? Okay, so this is like a good algebra problem with 5 unknown variables. But whenever we're trying to figure out questions like this, the best thing to do is first work backwards and really figure out what the situation is, because it's going to be different from person to person. For example, if someone's trying to obtain fast FI, like financially independent in a very short amount of time, like 5 years, maybe 10, that's going to be different than somebody who is going to take a traditional path, let's say 20, 30, 35 years to financial independence, okay, and a traditional retirement. Now, let's just take the fast FI route, okay, first, because this one is a little bit simpler. And when you're trying to do something really fast, like 5 years, first of all, I don't plan on any growth of investments over that such a short horizon, okay? Sure, there can be growth, but I would not anticipate it because there can also be losses. And within 5 years period of time, you don't necessarily have a lot of time to make up for losses. And even if the expected rate of return is positive, all right? So also the return, your portfolio is going to grow linearly, basically, with your contributions. Your contributions far and away are going to control what your net worth is more so than your investment returns. Okay, because if you're doing like a fast FI route, 5 years, you're basically putting in like, let's say 15 to 20% of your goal portfolio per year. And within each individual year, you're not necessarily likely to get a 15 or 20% return. Certainly you could, okay, but you wouldn't necessarily just plan on that each year for the first 5 years. Okay, but let's pretend you are going that route, fast FI. I don't plan on any growth. I just think about what my contributions are to hit a certain number, and then how will that number supply me with the income that I need to sustain myself. So with real estate, it's pretty simple. My original first blog post talked about utilizing an 8% cash on cash return for real estate. And basically, if you got to $1.5 million, 8% of that is $120,000. So it's $10,000 per month. So I would just focus on getting up to that $1.5 million and not necessarily worry about returns. Just worry about, hey, I'm going to chuck in $200,000 this year, $200,000 next year, etc., and get yourself up to the $1.5 million. There'll probably be some growth in there over those years, but if you're doing it in 5 years, you could put $300,000 per year, get to $1.5 million. Okay, it's just chunk it away. Let's say you're not doing real estate and you're doing publicly traded securities, okay, like in a retirement kind of work. Now, a lot of people will quote the 4% rule, originally, I think, presented by Bengen. And that's a good rule of thumb that you can sustain yourself off of 4%. The safe withdrawal rate would be 4% of your portfolio value at the time you start taking withdrawals. And that amount would stay the same every year, adjusted for inflation. Okay, regardless of what the portfolio does. So if you have a real estate portfolio and you took 8%, then you're basically taking an 8% safe withdrawal, even though it's just cash flow, as opposed to publicly traded securities, it's like 4%. Now, that's why with real estate, you can theoretically retire on half as much as you can with publicly traded securities. Now, these are generalizations, but they're good for working with just to kind of get started. So let's pretend that you are putting in $100,000 a year into retirement accounts through your job that are pre-tax. And over the first 5 years, that'll get up to $500,000. Okay. And in real estate, let's say you put in $100,000 there. So now you get up to $500,000 in each. So how much would you be able to sustain yourself with? Well, the real estate, $500,000 times 8% is $40,000. 4% withdrawal on the $500,000 publicly traded securities, retirement accounts, that's $20,000. So $20,000 plus $40,000 is $60,000. So with that $1 million, you could get a $60,000 annual withdrawal or $5,000 monthly withdrawal. Now, we're assuming with FastFi, you're not having a pension plan or other income streams, okay? Because if you have like a pension or Social Security, you would take that number off first, off of your goal passive income, and then you would just need to take whatever was left and reach that. Now, the 8% with real estate these days, if you're investing in new investments, I would soften that to around 7%, okay? A lot of people like to soften the 4% rule on publicly traded securities down to 3%. Now, I'm going to say something that other people are not going to agree with, but I'm going to explain. I think it's fair to actually use a 5% withdrawal rate from publicly traded securities. If you have a reasonable, not super aggressive allocation, like 60-40, which is what I like personally, or even less, like 40-60, because the drawdowns are not super low or not super high when you have a not super high equity portfolio. Okay, so like a 5% withdrawal rate. In addition to that, you also have the real estate side. The whole point of the 4% rule is what could you withdraw and not run out of money over a 30-year forward-looking projection, or at least the study was backward-looking, 30 years. Well, forward-looking, but retrospectively analyzing this. How could you live 30 years without running out of money to zero? If you have a bunch of real estate, even if that other portfolio theoretically went to zero, your overall portfolio isn't getting to zero, right? So you don't have to be like unbelievably conservative on both sides of the fence, because you have a diversified portfolio that the likelihood of going broke on both sides at the exact same time, very, very unlikely. So you could have like a 5% withdrawal rate on stocks and bond portfolio, even 6%. And then real estate, whatever it is, 7%, 8%, depending on how the cash flow is. So ultimately, I look at those two pieces. Is how much, well, first I look at how much do I want to have in cash flow? What other cash flow do I have, like pension plans? Subtract that. Then I look at how much I'm going to get from each of these pieces and see if I'm there. Now, with retirement accounts, you only have a certain amount you can put in per year. With real estate, you could put in as much as you want to, or in a taxable brokerage account. Okay, so these two things have different withdrawal rates. And so the amount of kind of cash flow you get from them are going to be a hybrid between the portfolio mix, how much is publicly traded versus how much is real estate. Now, there's no rules that you can't convert a retirement account to real estate when you're done working. Like you can, let's say you work for 5 years and you have $500,000 in retirement accounts. You could then roll that out into a traditional IRA. Or better yet, you could create a side business for a year so you have a solo 401k, or you could do a self-directed 401k, self-directed solo 401k. And you could roll all of those that money from retirement accounts into that self-directed 401k. Now you can have more real estate assets, so you can have a higher withdrawal rate. Okay, now this gets a little complicated because you have a retirement account which has early withdrawal penalties of like 10%, and you still have to pay tax on it. But if your taxable income is super low, that tax could still be minuscule. Like if your total taxable income is less than $100,000 and you're married, or more like $110,000 and you're married, you're paying like $10,000 a year in tax. It's not much tax. Okay. Now, let's pretend you're not doing like the fast FI route and you're going for a more traditional retirement. Now you actually have to take into consideration the future value of your investments, accounting for the growth of those investments. Okay, because now we're talking about multiple market cycles. We're talking about like 20 years. That's like 2 decades. That should be like at least 2 market cycles, right? And frankly, we're still in the same market cycle since 2008. This is like a 12-year market cycle, and we're still waiting for like a real dip. I mean, it dipped for like in March for a little bit, but hey, it could be tomorrow. Who knows? Okay. But now you actually have to consider growth. So when you're putting in money into retirement accounts at work, stocks and bond allocation, okay, so you should theoretically consider some sort of return on your investment. What is it going to be over the next 20 years? I don't know. But I don't think 6% is an unreasonable percentage to utilize as an expected rate of return over that entire horizon. There are going to be years where it's way below and years where it's way higher. But over like 20 years, I think 6% is reasonable. Now, with real estate, over that long a period of time, 6% is probably very, very reasonable because you're using leverage, right? So if you only got 6% per year on something that was an actual real estate investment, and you took the opportunities to strip equity out of it or sell it and buy another property, I think you should be well over 6%. However, if you buy something and you just hold on to it, what happens is over time, you're going to build equity in there, but that equity doesn't generate any additional cash flow. So it's actually kind of locked up. So it's kind of like, in a way, like a retirement account, like it's kind of locked up over there. But real estate equity does not generate cash flow unless you are literally like taking money out of that equity, like taking a HELOC and taking money as a loan from it. If you were to take money out of it and then reinvest it, and then new property or something else generates cash flow, then yeah, then you're utilizing that equity. But if you're just buying a property like a year and you do this for many years and you never sell anything and you never cash out refi and you never take a HELOC, the cash flow on the property is going to plateau, okay? And you're gaining equity, but that doesn't really put any extra money in your pocket, okay? So you have to be careful on how much you calculate the growth of that real estate portfolio, because even though that real estate portfolio is growing, the cash flow isn't necessarily going up as much as one would expect based on the value of it. So a lot of people focus on cash return, but you have to also consider what's called cash on equity return, which is the amount of cash return you're getting over the value of the overall equity you have on an asset. So if you have something that's appreciated a lot, you could still be getting 10% cash on cash, but you have all this equity you're just sitting on. Okay. So if you're strategic about it and able to capitalize on that equity in other ways, like a cash out refi, for example, and reinvest it into another deal, then yeah, you have to expect some growth of your real estate investments, whatever it is. It could be 6, 10, 15, who knows what percentage it will be. It could be very high if you keep on doing that. But certainly you would have to kind of forward project that. I use Excel. There's a future value function, which is the first time you use it is kind of clunky. You have to put in like negative numbers, and but you can figure it out. And you basically put in how much you're investing, the period, starting value, interest rate, and time, and you basically can calculate how much it's going to be worth at a time into the future. Okay, so that's how I think about it, forward looking for longer projections. You have different pots. You have your retirement accounts at work, and those are going to grow at X percentage. And boom, after 20 years, they'll be worth X amount of dollars based on all of your contributions. Okay, and then your real estate portfolio over the next 20 years will also be worth X amount at that period of time. And you could then take like a 7% or 8% of the real estate portfolio per year as cash flow. And on the investment side, 5% or so of the stock and bond portfolio from your retirement account. Now, you should consider that you're going to pay tax on any pre-tax retirement accounts. But especially if you're retired and you have real estate, your tax liability is going to be so small that it's really not that big of a deal, unless you're taking out huge amounts of money from pre-tax accounts when you're retired. Like talking like $200,000 plus, like really big dollar amounts. But if you're really doing that, then you can still be very strategic on how you do it, because you could take the money, invest it into real estate, take the depreciation on the real estate, offset the taxable liability from the withdrawals from the retirement accounts. And so you can just keep that tax liability very low. It's really easy to do that if you have real estate assets and you're not working anymore. Super easy. All right. That should be it for today's episode. Until tomorrow, episode number 128. I think I have some more questions from the group I need to catch up on. If there's any questions you guys have that you want me to answer, please put them there. If there are questions that you've asked before and I haven't answered them yet, feel free to tag me again and I'll see it again so I can remember. Okay. Let's see. I am looking at people's questions. Is real estate 8% passive or active? So real estate assets generate a return, and if you're actively doing it, then you're spending your time on that. There is nothing you can't do from an investment return perspective as a passive investor that you can't get as an active investor. Because if you're an active investor and I just partner with you, I'm just going to get my split of the profits. So people who think that as a passive investor, I can't force appreciation and do things like that. If you're passively investing, you're expecting the sponsors to do all of those things. The one thing you can't do is, because you're not in control of the asset, is make the decisions on the buy and the sell and the management of it. Okay, but even 1031 exchanges, you can do that passively. It's not as easy to, but certainly you can do a lot of this stuff passively. All right, so one more question or comment here. If you want to build up $1.5 million other than saving $20,000 per year for 5 years, can you count on growth? So I touched on that. And spreadsheet. I don't know what spreadsheet referring to. I didn't do a spreadsheet on this myself, but I do have a blog post in my on 39point6.com. It says real estate, the fast track to financial independence, I believe is what it's called. It's from like 3 years ago, but I can link to that on this movie. Okay, that is it. One more time. And again, this is only for my entertainment, hopefully yours. And none of this is legal, professional, financial, accounting, or other advice. Until tomorrow for episode number 128, have a great night.